United Capital PLC has projected Nigeria's inflation rate to hit 13.3% by the end of 2020. In the H2 2020 report, the firm also lowered real GDP growth forecast for 2020 from 2.3% to minus 2.69%. The biggest downside risk to the above projections remains the possibility of a second round of lockdown, especially if the virus continues to spread rapidly. As such, GDP growth in SSA, that's Sub-Saharan Africa, is projected to contract by 3.2% in 2020, the lowest level in more than 20 years due to the collapse in commodity prices. In the absence of a fresh surprise, oil prices are likely to hover from $35 per barrel to $45 per barrel for the rest of the year. Already, domestic economic growth in Q1 of 2020 slowed by 1.87%, and the figure for Q2 2020 is set to come in negative, despite the series of stimulus packages announced by the authorities aimed at easing the impact of the coronavirus pandemic on businesses and households. Well, on the exchange rate, United Capital's outlook for H2 2020 shows that the odds are in favor of a further Naira adjustment, which may take the official rate to 410 to 430 Naira per dollar by the end of the year. Overall, the Nigerian economy may enter a technical recession by Q3 of 2020 after 2 consecutive quarters of contraction in Q2 and Q3 2020, with a chance of early recovery in Q4 of 2020 or Q1 2021. According to the report, the spread of COVID-19 pandemic across the world triggered unanticipated global financial market volatility, and Nigeria was not left out. FPIs and local investors flew to safety amidst the collapse in the oil prices and currency adjustments. And what could have been a flourishing year for the Nigerian economy was caught in the web of a global public health crisis, which grounded domestic and external economic activities. The head of research at United Capital, Wale Olusi, joins me now via Skype from Marina for detailed discussion. Wale, thank you very much for your time on the show.
Thank you for having me, Tolu. Good afternoon. I
must confess, a very detailed report. Take us through some fundamentals, basics of this report before we now get to break it down step by step in the fundamentals and the main issues that brought up some of the submissions and conclusions in this report.
Okay, thank you for having me once again. In terms of the basics of the report, what we've looked at, I think is to start with is a review or a revised version of our annual economic outlook here at United Capital. In January, we already made projections for what we expect the year to be or how activities during the year should pan out. I think like so many other research houses as well as multilateral research agencies, one thing that we underplayed in January was the capacity of the coronavirus, which was actually brewing in China as when we released that report in January, to actually bring the entire global economy to a halt, as we saw from March this year. So what we have in the half-year report is a review of that. We now factor in, what has happened so far in the year and what this means for, for example, the global economy. What we expect there is a situation whereby uncertainties around coronavirus will continue to not only ravage many economies, but also devastate markets with huge population across the world. And of course, with government responses to that, it's going to take a toll on demand for economic activities, because with lockdown or gradual reopening of the economy, things will not go back to normal immediately. And of course, that also have implication for oil prices. And when you mention oil prices, or oil supply and demand, then countries like Nigeria will be affected. And then we narrow it down to the Nigerian economy, which has been gradually creeping out of recession. In 2016, growth was fastest last year based on what we saw February in 2020. Initial expectation was for us to sustain that, but now our projection, is, more blurry. We're now forecasting a contraction for 2020, just like you mentioned earlier. We're also seeing serious concerns around exchange rate, around yield in the fixed income market, as well as sentiment for investment in equities, without leaving out foreign portfolio and direct investments.
Let's look at global issues now, trade issues also between United States and China. All of these were part of issues we dealt with towards the end of the year and the start of 2020. Talking about also the UK and EU economic ties, vis-a-vis finally the pandemic coming in. How do you see all of this, or what role did all of this play in this report or in this review?
Okay, so if you look at international politics, and those are serious issues that we wrote extensively about last year, and the trade war between US and China, the Brexit issues, between EU and UK, the US-Iran issue. These are serious conversations that was driving global economic activities as well as global trade last year. What we thought earlier this year was that, because between US and China, they were able to reach its phase one deal, then even the Brexit deal was more or less sealed earlier in the year. So 2020 was going to be a fantastic year for not only Nigeria, but for the global economy in terms of trade. In Africa, we were looking at the possibility of a continental free trade agreement to start in July. But all of that has been thrown away now, because with the pandemic, there's a growing conversation between US, and China right now, because US think China wasn't completely, transparent with, how the virus broke out and all of that. In UK, everybody is all about safety now. So Brexit or not Brexit, nobody really wants to take visitors from countries that are considered highly risky as far as this virus is concerned. So these are serious issues that has, affected supply chains all over the world, has more or less affected trade flows. Yes, there's still trade, but it's considerably lower compared to what we used to have before the pandemic. So all of these are not going to just go away in the second half of the year. We think things will improve from where they were in Q2 2020, but they will not go back to the level they were last year or in Q1 2020. That's what our projection for the rest of the year is looking like.
I'm also looking at trade, when trade is likely to return to pre-COVID level, as economies across the world continue to grapple with, of course, the pandemic and also global demand and supply value chain. There's a break, there's a disruption when it comes to even value chain, supply value chain at this time, Wale.
Yes, trying to forecast when things will go back to normal. From the report, that's one of the most difficult things to do, because for one, we don't know a lot of things about the virus. Like you mentioned, even if it's not a second wave, there's still a lot of issues. The virus is growing in other countries that are not making news before. For the bulk of March and April, part of May, it was the US, Italy, Spain, and the UK. But at the moment, the big issues are happening in emerging markets like India, Russia, and Brazil, and so on. And other countries that don't have enough testing kits. Some of them will still have to face this virus still. And the responses across the world by different governments will be different. We don't have the same capacity. In Africa, for example, what we are going for is debt. But in the more advanced world, they have enough arsenal in their balance sheet to throw a lot of dollar at the virus. So, maybe in 2021, perhaps mid 2021 upward, or when the vaccine is actually out, from all what the health officials are telling us, it take a while for vaccine to be, concluded. And even though many of them are accelerating the process now, we still don't have any, serious deadline as to when that is going to come. Perhaps the only good news is a recent drug, coming from the UK that is slightly cheap.
True.
But I mean, how fast can that go around the world? So for the global economy to return back to the pre-COVID level, I think it will take a while. We can only adjust to this virus. And so economic activity will also take a cue, because at the end of the day, it looks like safety is coming first ahead of anything. And it is only those of us who are around or alive that will be able to carry on with the economy. Like the Ghanaian president said, we know how to bring back the economy, but when people die, we don't know how to raise them back to life.
Indeed. Well, let's now come to sub-Saharan Africa, which is by far the most vulnerable. Such issues around GDP growth for the sub-Saharan African region is projected to contract by as much as 3.2% in 2020. According to the review, the lowest in more than 20 years, sharply due to the collapse in commodity prices. How does this come to you?
Well, I mean, for many African countries, what we have, continued to focus on has been commodity exports. Nigeria is mostly oil. More than 90% of our exports, is oil or oil and gas related exports. If you go to South Africa, that's a better diversified economy, but what you still have is the mining sector dominating the bulk of the economy. And if you go to Ghana, they are rich in cocoa. They're a bit more diversified also, but cocoa, now they have oil, and then there's gold. I mean, if you go across the continent, Angola is oil. If you go to Kenya, it's probably coffee or some form of horticultural goods. So Africa still focus so much on primary product exports. And once there's a shock like this, primary exports take a serious beating, and most of us, you can't cope with that. So in terms of the economic vulnerability, poor countries in Africa are going to be the most hit. And that's why you've seen a lot of facilities extended to Africa from the IMF, from the World Bank, a lot of debt forgiveness. Also because, the debt level has been increasing, and the IMF, the World Bank, these are agencies that have been complaining about the level of debt sustainability in Africa. Now, with this virus, just like the most vulnerable people who have underlying ailments, or, they are very old, those are the ones dying from this virus. The same thing applies to the economy. The poorest of the poor are the ones that that tend to suffer. Imagine when the economy was on full lockdown. Those that depended on daily activities, daily trades to sustain their livelihood. Those are the ones that we were all given palliative measures. The same thing applies to the economies. That's why we think, many African countries who depend so much on debt, who depend so much on commodity exports, many of those exports are not going through as fast anymore. They will be the most vulnerable, and that's why the IMF, the World Bank, they are forecasting, the first decline in about 20 years for the region as a whole. And when the large economies such as Nigeria and South Africa are touched, then the entire region is going to be, significantly affected. And I give you an example when Nigeria closed the border with Benin and related economy. Because of that singular action, Benin Republic, was struggling for a while, basically because that's an economy that depended so much on the sheer size of Nigeria. Same thing applies here.
Indeed. Wale, let's now talk about the shape, duration, and size of recovery, varying from country to country. I agree with that, depending heavily on the improvement in the external dynamics and the frame required to bring economic activities back to pre-COVID-19 levels. What are you thinking? What kind of recovery are we going to see across board?
So people have talked about V-shape, U-shape, or W-shape, or even L-shape. I keep hearing about L-shape, where you are probably trapped, in a serious, I don't know, flattish kind of growth. But maybe not V-shape. V-shape is a situation where you contract one and you jump out almost immediately. U-shape, perhaps, you slide in, then you don't recover straight to the pre-COVID level immediately. But then in the consecutive quarters, you start riding out gradually. That's what it looks like. But at the end of the day, it also depends on the size and the efficiency of, policy responses coming from both the monetary policy and the fiscal policy authorities. In Nigeria, I think we must commend the authorities. Central Bank is doing everything it can. They took a bold step in May when they cut the MPR, despite concern around FPI's flows. They cut MPR by about 100 basis points to 12.5. Market interest rate is at record low. The only reason why you want to do that at single digits, many investors are complaining because yield on fixed income assets are considerably low. But the only reason why you want to do that is to make access to funding very cheap. And we've seen a lot of corporate approach the capital market to raise capital. More than 400 billion have been raised in CP this year alone. And we've seen a number of corporate bonds as well. That's because interest rates in the debt capital market is very cheap. The only reason why the central bank wants to do that is to stimulate growth. How effective that will be, I think only time will tell. On the fiscal policy side, we've seen the vice president-led committee, initiate a stimulus package to the tune of about 2.3 trillion naira. If this is executed 100%, maybe we will be able to very quickly jump out of, this contraction from Q3 or Q4, and if that's achieved, then it's looking more like a U-shape, really.
Oh, that's a very good word. In one word, Wale, before I let you go, we're already out of time. Do you see us running away from recession? Or is it just going to be a technical recession? Let's round that up in 30 seconds.
We can only hope. We are very optimistic here in United Capital that Nigeria being a very large economy and looking at everything our policymakers are doing and the sheer size of Nigerians ourselves, we are very resilient people. I think we can come out of this as fast as we can. We are the largest in Africa. We have demonstrated a lot of capacity to bounce back. So I think Nigeria, can always find a way.
All right, Wale, thank you very much there. Wale Olusi is the head of research, United Capital PLC. Thank you very much for breaking down this review for us and to look at what we project for us to move on in the year. Let's quickly move